Our portfolios performed well in the last quarter of 2025 and have continued so in 2026. Part of the reason for this was the ongoing derating of many of the high-flying growth stocks, a bit like what's happening to many of the tech names in the US. Our team put this chart together to highlight some of the deratings. We picked a collection of big cap Australian stocks across a range of industries. The blue columns represent the peak price earnings or PE multiple that particular stock has traded on since January 2020. The brown columns represent the PE multiple as at December 2025. The multiples are all based on FactSet consensus earnings, so it's not as if it's impacted by our own potentially overly cautious forecasts. A few observations. The healthcare deratings were particularly severe, as evidenced by Cochlear, that's code COH, and CSL. CSL is particularly noteworthy as it went from a PE of almost 50 times, and at that time the biggest stock in our market, down to less than 20 times. Now, some of the deratings have provided opportunities for our portfolios. We now own both Woolworths, code WOW, and CSL, now that they have been more sensibly priced. However, most of the rest still look pretty expensive to us and hence not held. Highlighting two of the biggest names. CBA has derated from a PE of around 30 times down to about 25 times. But that still looks pretty rich to us for a bank with minimal earnings growth. Similarly, Wesfarmers, code WES, as owner of the Bunnings hardware chain, has come down from a PE in the high 30 times to the low 30 times. Now, that stock is forecast to grow earnings low single digits, say around 4% over the next few years, and we can't see why you will pay over 30 times for that type of growth. So valuation still matters, eventually.